When we're taking a look at what's happening with time, we've throughout the day really looked at the different times that we want to avoid as intraday traders. And we're also looking for those sentiment shifts. And in these 2 weeks, which we are still very much within, first 2 weeks of August, we can see the lower volume. And in a lower volume environment, it's easier for the market to sort of get jerked around and pushed and pulled with a whole lot more ease. The fewer people in the room, the easier it is to move the market around. So what we want to remember is just a few of these times we've talked about before in previous free videos, recap videos, and then also remembering that it's not just about the lower volume and the concern for the sentiment shifts, it's also concern for follow-through. So let's talk about follow-through for a moment and quantify, probably what we want to do anytime the market is in what we call guillotine syndrome. It doesn't want to stick its neck out too far. It knows that there's something around the bend, or it knows that there's just not enough participation to get the follow-through going. So we know we're just not going to see the type of movement in line with the, say, high hourly price movement ranges. Sometimes we won't even see the low on the hourly price movement ranges. So let's take a look at an example, and we'll use the Russell in this case. So this morning, when we sent out the alert for the clearing range breakout, it was, using that first 9:30 to 10 o'clock opening range or clearing range, and then taking the break of that high in anticipation of follow through. Now, in a normal, much more normal futures volume environment, the follow through we know is it's actually pretty easy to get that 6 points, that 7 points out of the market. But we've noticed really the last week, and this one too, here the first day of this second week of the summer doldrums, it's been tough to get the follow through even on the low end. So what I typically recommend to traders is one of two things. Look at the expected price movement range. And this is a tool that we use for those of you that haven't seen it. This is a tool that we use from Auto Chartist. This is going to be part of a conversation, a much larger conversation we're going to have in September. In fact, mark your calendars. I believe we're going to have the webinar for this. I'm looking at we're going to have the webinar for this on the 6th of September. And then I believe on the 15th, we're going to have a class that's going to talk a lot about this particular tool and how we use it. So this is a tool called Volatility Analysis from Auto Chartist. If you haven't got it already, I send the information out from within the chat, or just ask me and I'll be more than happy to give you the information. But it's autochartist.com, just like the link says. Now, if we look at the expected price movement range, the neat thing about the EPMR, which is what I call it, the nice thing about this is it's almost like the marriage of the historical price movement plus current volatility. So if you were to sort of use a little bit of what a lot of you like with, say, ATR, which is not the same thing as a PMR, but if you were to marry sort of price movement range, which is what I use, with ATR, which I know is quite popular, what you get when you slap those two together is really much more in line with the expected price movement range. And the expected price movement range will say, hey, I know that the typical price movement range is somewhere in line with this, but the current volatility just isn't justifying it. And it will adapt, it will reflect a little bit more accurately some of the lower price movement ranges, or higher, whichever way it is, that we'll see. So it makes a lot of sense to, kind of make a pit stop here and look for that. Another thing you can do, and it's not, an easy thing by any stretch, but is to look at the lower end of price movement range. For example, not just what's happening during, say, our prime time hours here, but look at the lower end. So start with 9, go to 4, right? So 9 to 4 in here, 9 to 4 in here, and use the lower end of price movement range and say, you know what, I know I could see 6 or 7 points during this time of day, but what are the chances we might just see 4? Right? So use the lower end of price movement range to account for days like this, where this kind of guillotine syndrome is kicking in a little bit more. And this way you can keep it very repeatable, you can keep it very objective, and you can do this across any of these markets. Doesn't matter if it's futures index or if it's crude oil or whatever. So again, normally I would expect what? So in the vicinity of 8, 10, 12 and a quarter points as far as follow through once I get long. But during this time of year, gosh, I might be lucky just to get 6. So just look at the lower end of price movement range or the EPMR to have a better idea of how much the market could go once you're in. And then I think the other thing we're going to talk about here is how to use the 1 minute chart. And we'll talk about that in the next conversation here.